three biggest mistakes with short-term debt when it comes to getting ready for your first mortgage or for any mortgage to buy a house. So these are problems that I'm going to talk about that I see on a regular basis in my role as a mortgage broker or mortgage advisor. And if you have a little bit of foreknowledge around how to handle debt and short-term debt, then you can position yourself in a way that is much, much better and will make the lenders and the banks look at you much more favorably. So the first thing that I'd like to mention is that, or bring up, is that one of the biggest problems is that people get into short-term debt at all. And my biggest advice is, if you want to keep things really, really simple, really, really clean, and just not even have to deal with the other problems that come with short-term debt, that is, just don't get into short-term debt, okay? When you borrow money on a credit card, or when you borrow money on a personal loan, or for a car loan, or for a store card, any of these sort of types of products to buy something, the reason that you are borrowing money from these different institutions is because you literally cannot afford that thing, okay? Now, if you could afford that thing, you would have the cash in your own bank account and you could just go to the shop and you could just buy it, okay? The very use of definition is basically saying that you can't afford it. You're having to borrow money to buy something. And the thing to be aware of here is that nearly most of the things that, or nearly all of the things that people borrow money for are depreciating in value. So if you're buying a car, that's definitely depreciating in value. If you're buying clothes, definitely depreciating in value. Jewelry, depreciating in value. Pretty much everything that you buy, except for a house, will depreciate in value. So you've got to ask yourself the question, why would you want to borrow money for something that's going to depreciate in value? How about, as an alternative, setting up a savings account, and each time you get paid, put some cash straight across to the savings account. That's the very first thing that you do when you get paid. Put some money across to the savings account, accumulate some funds there, so that when you do see that piece of clothing that you really want to buy, or it's time to go and buy a car, you've actually got the cash saved up so that you can just go out there and get it without having to borrow money, usually at high interest rates, to go and do that. So that's number one. Number two is credit card limits. Now, banks are really good at giving you high credit card limits. And often each year or every 2 years, they'll say to you, hey, you've done really well, we're going to give you a higher credit card limit. This is dangerous on two different levels. The first reason is, if you've got a high limit, like I would consider anything over $5,000, to be honest, to be a high limit, $5, $10, $15, $20,000 limits on your credit card, that just means you've got a lot more space to go wrong. You can spend right up to those high limits and without any accountability, and then it's easy to get up there, but really hard to get it paid off again. So one, high credit card limits are dangerous because of that. The second reason that high credit card limits are dangerous is that when you apply for a mortgage, let's say you've got a $10,000 credit card limit. Now let's say you pay it off every month, which means that you're paying zero interest on it at all. Now, you might think that that's great because you pay it off every month, but from the bank's point of view, you still have a $10,000 debt, okay? Now, the reason that the bank considers that to be a $10,000 debt is because if you wanted to, you could go out tomorrow and spend $10,000 on that credit card, because of that high limit, you have the ability to spend $10,000 whenever you want. So the bank will count that as being a debt, and that is held against you when you're applying for a lending in a mortgage situation. All right, so that was number two. And then number three, I wanted to talk about the various schemes that you see in the shopping malls, which are basically all buy now, pay later types of schemes, because there's lots of these around now. There's numerous different companies that do the buy now, pay later sort of type products. And usually the payments are being done over maybe 4 payments or 6 payments, something like that. And they've structured this in such a nice way so that it looks really harmless, because provided that you pay off your item that you've bought over the right period of time, you won't pay any interest, okay? So please don't kid yourself into thinking that this is a good idea. This is not a good idea. Okay, the reason that it's not a good idea is that even though you might go out there and buy yourself a nice, pants or dress or whatever it is, using this type of method, and you might go into it with the greatest intentions of paying it off within the allocated time and not paying any interest, the stats are something like 50% of people do end up paying interest. Okay, so a lot of people do end up paying interest anyway, because even though you have great intentions at the beginning, life doesn't always go to plan and budgeting doesn't always go to plan, and then you end up paying interest. Now, the companies that provide these products are very, very aware of this. That's why they lay it on and make it so easy to get in, but it's hard to get out. Okay, so it's a little bit like a crayfish pod, easy to get in, much harder to get out. It's best just to not go in at all in the first place, and I'd recommend that you don't use these types of products. Now, what you can do instead, of course, is once again save up some cash and go out and buy the products that you really, really do want using cash, which you've saved up, which means you're not having to pay any interest. You're not using anyone else's money. And once again, if you're having to go and borrow money to buy something, it means you can't afford it. So it's a good idea to listen to that, acknowledge that you can't afford it, and just wait, have some delayed gratification, and wait till you can afford it. Now, if you find that you're actually in a debt situation currently, and you might have racked up a number of different debts and it's starting to get on top of you, and you're not quite sure how to handle it, then what I'd suggest that you do is click below and to get our PDF on how to get rid of debt in the 3 best ways possible. I think you'll find this really helpful and will help you take control of your situation. And it's really great if you do that, because it's recognizing that there is an issue there already, and that's the first stage in sorting out the problem, is recognizing that there is a problem. And now with the PDF below, you can take action to sort out that problem and really get on top of things, which will help you sleep a lot better at night and give you a much better financial future as well.